Cryptocurrency is a type of digital or virtual currency that uses cryptography for security, making it difficult to counterfeit. Unlike traditional currencies issued by governments like the US dollar or the euro, cryptocurrencies operate on decentralized networks based on blockchain technology. A blockchain is a distributed ledger that records all transactions across a network of computers. Decentralization in the realm of cryptocurrencies fundamentally involves distributing control and decision-making from a centralized authority, like an individual or an organization, to a dispersed network of independently operated nodes spread across various locations. This network, primarily powered by blockchain technology, serves as a type of distributed ledger that records all transactions. Each transaction is added to every participant's ledger, thereby decentralizing the information and maintaining its integrity and transparency. In cryptocurrencies, decentralization is achieved through consensus mechanisms, methods by which all participants in the network agree on the validity of transactions before they are recorded on the blockchain. Popular consensus algorithms include proof of work (POW), which Bitcoin uses, requiring nodes to solve complex mathematical puzzles to validate transactions and create new blocks. Proof of stake (POS) and delegated proof of stake (DPoS) are alternatives that select validators based on the amount of currency they hold and are willing to stake, offering improvements in energy efficiency and transaction speed. The benefits of such a decentralized approach are manifold. It enhances security by making the network resistant to attacks and fraud, since compromising one node does not impact the integrity of the network. It ensures transparency as all transactions are publicly recorded and accessible to anyone on the network. Additionally, decentralized networks are inherently resistant to censorship and less susceptible to corruption and mismanagement, as there's no central authority to exert control over the system. However, decentralization comes with its challenges. Scalability issues arise as more transactions are added to the network, potentially slowing down processing times and increasing costs. Interoperability between different blockchain networks is another challenge, as systems often operate in silos without the ability to communicate or transfer value across blockchains. Furthermore, networks relying on POW are criticized for their substantial energy consumption, raising environmental concerns. Lastly, the lack of centralized control makes regulatory compliance complex, potentially deterring wider adoption due to regulatory uncertainties. While decentralization offers significant advantages over traditional centralized systems, especially in terms of enhancing security and promoting transparency, it also faces several hurdles that need addressing as the technology continues to evolve and expand. Cryptography is a fundamental component of cryptocurrencies, employing advanced mathematical and computational techniques to ensure transaction security, verify the transfer of assets, and control the creation of new units. It plays a crucial role across several areas of cryptocurrency functionality and security. The primary function of cryptography in cryptocurrencies is to encrypt transactions. This encryption protects the data exchanged between parties, making it accessible only to the sender and the intended recipient and safeguarding against unauthorized access. In addition to transaction security, cryptography is integral to the use of digital signatures in cryptocurrencies. Digital signatures are employed to confirm the authenticity of transactions, asserting that they have been authorized by the rightful owner of the funds. This is achieved through a pair of keys, a public key that is openly available on the network and a private key that is confidentially held by the owner. When a transaction is initiated, it is signed with the owner's private key. The network then uses the corresponding public key to verify the signature, ensuring that the transaction has not been tampered with and is legitimate. Another critical application of cryptography in cryptocurrencies is through hash functions. These functions are used to maintain the integrity and structure of the blockchain. Hash functions produce a unique fixed-size string of bytes for each input, which makes it computationally feasible to alter any part of the blockchain without being detected. This feature is particularly important for mining and securing the network. Miners solve cryptographic puzzles to validate transactions and add new blocks to the blockchain, a process known as proof of work. The complexity of these puzzles ensures that rewriting the blockchain's history would require enormous computational effort, thus securing the network against fraud. The cryptographic foundations of cryptocurrencies provide robust security by protecting against hacking and unauthorized fund access. They ensure the integrity of the transaction history, creating a tamper-proof record. Cryptography also facilitates the verification of ownership without revealing any personal information, thereby supporting privacy. However, cryptography in cryptocurrencies is not without its challenges. The complexity of cryptographic algorithms can make them difficult to understand and implement securely. Moreover, the emerging field of quantum computing poses a potential threat to the cryptographic systems that protect current cryptocurrencies, although this also stimulates research into new quantum-resistant cryptographic methods. Cryptography is indispensable in enabling secure, private, and reliable transactions within the cryptocurrency system. It supports the core features of cryptocurrencies, including decentralized consensus and digital ownership verification, making it a backbone of this digital financial architecture. Cryptocurrencies are built on blockchain technology, which is essentially a public ledger that records all transactions across a network. Every transaction is openly recorded on the blockchain, making the information accessible to anyone in the network. This level of transparency ensures that all transactions are visible and traceable, which is crucial for building trust among users. It allows for a high degree of auditability, where anyone can verify and assess the history of transactions without needing permission from a centralized authority. This transparency can deter fraudulent activities because altering any record on the blockchain would require changing all subsequent blocks and the collusion of the majority of the network, which is impractical in a large and active network. Moreover, in systems that use proof of stake or similar consensus mechanisms, stakeholders have a vested interest in maintaining the integrity of the network, further securing the system. While all the transaction details are visible on the blockchain, the identities of the individuals performing those transactions are not directly exposed. Users interact with the blockchain via addresses, which are random strings of characters not linked to any personal identifying information by default. This system provides a level of privacy for users as their real-world identity can remain hidden behind their blockchain addresses. However, this anonymity is partial and better described as pseudonymity because while names are not directly connected to transactions, individuals' addresses can sometimes be traced back to them through various means. For example, if an address is used on a cryptocurrency exchange that adheres to Know Your Customer (KYC) regulations, the exchange can link the address to a real identity. Additionally, sophisticated blockchain analysis tools can track patterns of transactions that may eventually link addresses to specific individuals or organizations. The dual features of transparency and anonymity create a unique balancing act. On one hand, the transparency of the blockchain promotes fairness and accountability, helping prevent fraud and corruption by making every transaction traceable and permanent. On the other hand, the pseudonymity protects user privacy, which can be crucial for personal security or financial confidentiality. These characteristics also present challenges. The transparency and traceability of transactions mean that once an individual's identity is associated with a particular address, their financial actions on the blockchain can potentially be traced, sometimes leading to privacy concerns. Conversely, the anonymity aspect has been criticized for potentially facilitating illegal activities such as money laundering or financing terrorism because individuals can transact without easily traceable identities. The transparency and anonymity offered by cryptocurrencies via blockchain technology provide both significant advantages and notable challenges. While they enhance trust and security within the digital currency system and offer a degree of user privacy, they also require careful regulation and technological advancements to address the associated risks effectively. The digital nature of cryptocurrencies fundamentally distinguishes them from traditional tangible forms of currency such as coins and bills. As entirely digital assets, cryptocurrencies exist as lines of computer code that hold monetary value, stored in digital wallets and transacted directly over the internet without intermediaries like banks or payment processors. Cryptocurrency transactions are conducted on networks, typically blockchains, that facilitate the secure transfer of digital currency between users. When a user initiates a transaction from their digital wallet, it is broadcast to the network, verified through consensus mechanisms, and recorded on the blockchain. This process enables transactions to be completed swiftly and allows for immediate cross-border exchanges, which are particularly advantageous over traditional bank banking, especially regarding accessibility and transaction speed. One of the most significant benefits of cryptocurrencies being digital is the efficiency and inclusivity they offer. They can be accessed by anyone with an internet connection, making them available in underbanked regions where traditional financial services are limited. Moreover, the lack of physical intermediaries in transactions often results in lower fees, especially for high-value and international transfers. Cryptocurrencies can also be divided into very small units, which enhances their use in a wide range of financial transactions. However, the digital nature of cryptocurrencies brings with it several challenges. The value of digital currencies can be extremely volatile, with prices capable of significant fluctuations within short time frames. This volatility is influenced by factors such as market demand, investor sentiment, and geopolitical events. Additionally, while the underlying blockchain technology is secure, the platforms and wallets that store cryptocurrencies can be susceptible to hacking. Users also face the risk of losing access to their assets if they misplace their private keys, which are required to access their digital wallets. Furthermore, the reliance on technology means that consistent access to a stable internet connection is necessary to engage with cryptocurrencies, which could limit their use in areas with poor technological infrastructure. Regulatory concerns also arise with the digital and somewhat anonymous nature of these currencies, as they can potentially be used for illicit activities such as money laundering and tax evasion. This has prompted discussions about more stringent regulations, which could impact the decentralized ethos and ease of use of cryptocurrencies. The concept of limited supply is fundamental to many cryptocurrencies and significantly influences their design and economic characteristics, distinguishing them from traditional fiat currencies that can be issued indefinitely by central banks. In the world of cryptocurrencies, a maximum number of coins or tokens that will ever be created is typically predefined and embedded into the currency's code. For instance, Bitcoin, the first and most notable cryptocurrency, has a capped supply of 21 million coins, a threshold expected to be reached around the year 2140. Limiting the supply of a cryptocurrency serves several purposes and has various impacts. Primarily, it helps control inflation, which can erode purchasing power in traditional fiat currencies when excessive amounts are printed by governments. The scarcity created by a fixed supply cap can preserve or even enhance the purchasing power of the currency over time, especially if demand increases or remains steady, potentially leading to price appreciation. This feature also makes cryptocurrencies attractive to investors who speculate on the appreciation of these assets due to their limited availability. Furthermore, the fixed supply contributes to a predictable monetary policy, which is transparent and immutable once set by the initial programming. This predictability is appealing to those who prefer financial systems that operate independently of the sometimes unpredictable and reactive policies of central banks and governments. However, the limited supply of cryptocurrencies also introduces challenges. It can contribute to significant price volatility, as the value of these digital assets is heavily influenced by market sentiment and speculative trading. The fixed supply can amplify price fluctuations in response to news and market trends. Additionally, a fixed cap on supply can lead to economic deflation, where the value of money increases and prices decrease. While deflation might seem beneficial, it can discourage spending and investment if prices are expected to fall further, potentially leading to economic stagnation. As cryptocurrencies grow in popularity and their units become scarcer, the competition for mining new coins intensifies, which can lead to resource-intensive operations and concerns about fair allocation of new units. Moreover, questions about the long-term viability of cryptocurrencies arise, particularly regarding what happens when the maximum supply is reached. For example, once Bitcoin reaches its supply cap, miners will no longer receive new Bitcoins as rewards and will have to rely on transaction fees for compensation. This shift could impact the security and maintenance of the blockchain if the fees do not sufficiently incentivize miners. While the limited supply of cryptocurrencies introduces benefits such as inflation control and predictable monetary policy, it also poses significant challenges, including increased market volatility, potential deflation, and concerns about long-term network sustainability. Addressing these issues will be crucial for the continued adoption and functionality of cryptocurrencies. Cryptocurrency stands as a revolutionary technology that challenges the traditional monetary systems. Its inherent characteristics of decentralization, cryptographic security, transparency, coupled with anonymity, digital nature, and limited supply, contribute to its potential to redefine financial transactions. However, the journey of cryptocurrencies is not devoid of hurdles. Balancing the benefits with the potential risks and regulatory challenges will be crucial for the broader adoption and long-term viability of cryptocurrencies. As this technology continues to evolve, it promises to shape the future of money, offering a more inclusive and efficient global financial system. Please like and subscribe if you enjoyed the video.